Donating to charity is a generous act that can also provide helpful tax benefits, but claiming a deduction for your donations is not as simple as writing a check and subtracting that amount from your income. The IRS has strict guidelines regarding what qualifies as a deductible contribution, how you must document your giving, and what limits apply based on your annual income. Many taxpayers miss out on deductions because they lack proper receipts, donate to non-qualified organizations, or fail to account for goods and services they received in exchange for their gifts. In this guide, we will look at the essential rules of the charitable deduction, explaining how to verify a charity's tax status, what records you must keep, and how to deduct non-cash donations. By the end of this video, you will know exactly how to structure and document your giving to stay fully compliant with IRS standards. To claim a deduction for a charitable gift, the recipient organization must be a qualified charity under IRS rules. This generally means the organization must be registered as a 501c3 nonprofit. Contributions to individuals, political parties, social clubs, or foreign organizations are not deductible. If you give cash to a family member in need, that is a kind gesture, but it is not a tax-deductible contribution. To verify an organization's status, you can use the tax-exempt organization search tool on the IRS website. Once you verify the charity is qualified, you must understand the documentation rules. For any cash donation under $250, you must keep a bank record, such as a canceled check or credit card statement, or a written communication from the charity showing the organization's name, the date, and the amount of the contribution. For donations of $250 or more, you must obtain a contemporaneous written acknowledgement from the charity. This acknowledgement must state the amount of cash donated and clarify whether the organization provided any goods or services in exchange for the gift. Contemporaneous means you must obtain the document before you file your return. If you file your taxes in March but do not receive the acknowledgement until May, the IRS can disallow the deduction if you are audited. Thus, securing these statements promptly is a critical task for anyone hoping to claim charitable deductions on Schedule A. Another common oversight relates to the exchange value of gifts. If you buy a ticket to a charity dinner for $100 and the dinner is valued at $40, you can only deduct $60. The charity's receipt must clearly outline this breakdown, and you must subtract the value of the benefit received from your total deduction. Failing to do this is a standard filing error. Donating non-cash items, such as clothing, household goods, or appreciated stock, introduces additional rules. If you donate used items like clothing or furniture, they must be in good used condition or better to qualify for a deduction. You must calculate the fair market value of these items, which is the price they would sell for in their current condition, not their original purchase price. For non-cash contributions under $500, you must keep a receipt from the charity describing the property and its condition. If the total value of your non-cash contributions exceeds $500, you must file Form 8283 with your tax return, detailing how and when you acquired the property and your cost basis. Furthermore, if you donate an item or a group of similar items valued at more than $5,000, you must obtain a qualified written appraisal from a certified appraiser. For example, if you donate a piece of artwork valued at $6,000, a simple receipt from the museum is insufficient. You must hire an independent appraiser to certify its value, and the appraiser must sign your Form 8283. A major exception to the appraisal rule is publicly traded stock. Donating appreciated stock is an effective tax strategy. If you donate stock you have held for more than a year, you can deduct its full fair market value and avoid paying capital gains tax on the appreciation, representing a double benefit. This approach is highly favored by investors because it allows them to maximize their charitable impact while minimizing their investment tax liability. However, you must transfer the stock directly to the charity's brokerage account. If you sell the stock first and donate the cash, you will still owe capital gains tax. Finally, you must be aware of the annual limits on charitable deductions, which are calculated as a percentage of your adjusted gross income or AGI. For cash donations to public charities, you can generally deduct up to 60% of your AGI. If your donations exceed this limit, the excess amount can be carried forward and deducted on your tax returns for up to 5 subsequent years. For non-cash donations of appreciated property held for more than a year, the deduction limit is typically lower, capped at 30% of your AGI. Understanding these limits is essential if you plan to make substantial contributions relative to your income. To make the most of your giving, consider setting up a donor-advised fund. A donor-advised fund allows you to make a large contribution of cash or stock in a single year, claim the immediate tax deduction, and then distribute the funds to specific charities over time. This is an effective way to implement the bunching strategy we discussed previously, helping you exceed the standard deduction threshold in a high-income year. In summary, claiming charitable deductions requires verifying the organization's status, obtaining timely receipts, valuing non-cash items accurately, and staying within AGI limits. By following these rules, you protect your deductions and ensure your charitable intent is rewarded. When compiling your tax documents, separate your receipts by category: cash donations, non-cash goods under $500, and large items requiring appraisals. Create a simple summary sheet showing the date, recipient, and amount for each contribution. This structured approach simplifies entry into tax software and ensures you do not overlook small donations, like monthly recurring contributions, which can add up to a significant deduction over 12 months. By establishing these documentation habits, you make your filing process stress-free and maintain compliance with federal guidelines. To ensure you have a complete understanding, it is also helpful to look at how these concepts apply in everyday scenarios. Many professionals recommend documenting every step of the process, keeping organized records, and checking for updates to regional regulations at least once a year. By staying proactive and monitoring these changes, you can adapt your approach, avoid common pitfalls, and make more informed decisions that align with your long-term objectives and protect your household budget from unexpected expenses. Tax Season School explains tax rules, tax documents, and simple filing habits in plain English. The channel covers W-2 basics, freelance filing, deductions, HSA rules, and common mistakes so viewers can stay organized and make informed decisions with their money. This video is general financial education, not professional tax, accounting, legal, or investment advice. Tax rules change frequently and vary by location and situation. Consult a certified public accountant or tax professional before making tax decisions.